Hit it.
It's Friday, January 14th, 2022, episode 164. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show legendary investor Jim Leitner. We have a fascinating discussion about how Jim sees the markets today. He's definitely changed his tune from the last time he was on his show, believing the Fed has gone from being a tailwind at your back to a headwind in your face. Jim explains how he is adjusting his portfolio for this new environment. Then, folks, Kuppy's Corner is delayed one more week as we had some scheduling challenges. But don't worry, Harris will be on next week, and he will be interviewing a special guest. So make sure you stay tuned. And also, don't worry, Patrick is here to convince us that technical analysis is not some mystery phenomenon like astrology, but a real honest-to-goodness financial market tool. Let's see if he has any luck, but I'm doubtful because earlier he was asking Lean and I about our signs.
We end this week's segments of No Stupid Questions and Skin in the Game, and well, we might even drink some beers along the way here. So stick around. We got a great show. All right, Lena, hop on. What beer am I drinking this week?
So Patrick, the international man of mystery today, is drinking Local Group Brewing Company's Blurry Eyes New England IPA from Houston, Texas.
Nice. Let me give this a try. Ooh.
So a prototype for the modern New England IPA, hazy with lots of juicy hop character, a touch of bitterness, and very persuasive. What does that mean?
You know what? I think you would love this, Kev.
Really?
Oh, yeah. It's you like the New England
I love
stuff,
the IPAs, yeah.
All right. Anyway,
I'm more interested in, apart from your beer, is what's the weather like down there?
it's nice. It's nice. I mean, I'm going to use Celsius, but it's anywhere in the 15 to 20.
Oh, so it's not hot or anything.
Comfortable
No, it's
weather.
not hot, but you have to kind of put on a sweater or something. You don't want to walk around in T-shirt, shorts, but it's nice weather down here. It was great. Had a great week just trading with members at our mastermind session. Just a bunch of big picture trading members there. It was great. And then obviously I was hanging out at George Gammon's show. Got a chance to hang out with Lynn Alden and Chris Cole and stuff. It was a lot of fun.
Oh,
Anyway.
By the way, you missed the -19 up here in Canada. So you did well.
It's happening again
Lena,
tomorrow.
Is it? Lena, why don't you tell people about the merch before we go on?
Well, as Patrick mentioned, if you need a sweater of any kind, you can also find a
Well
nice
done,
hoodie
Lena. Well
at our
done.
merch store. You can get one with Patrick's face on it if you'd like.
No, thank you.
So you can go check out our merch store at markethuddlemerch.com.
All right, side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include apple acidosis, the curious commodity combustions, and the feckless Fed fumbles.
Nice. All right, let's get to our interview with Jim.
Well, it's our great pleasure to welcome back to the show extraordinary investor, wonderful human being, Jim Leitner. Jim, thanks for coming back.
So excited to be here. I think this is my fourth time.
It is. You're a regular and you're a fan favorite. People love hearing it, and it's been a while since we've chatted, so we'd love to hear what you have in store for us. And I think one of the ways that we could start is that you had three different, let's just say, themes that we talked about over the years that you've been on the show. One of them is listen to the Game Master, Zero Doesn't Win, and then probability matching. Why don't you just kind of do a little review of those themes and what you see in terms of those themes right now?
So listen to the Game Master, I think, is as relevant as it always has been. You know, we just had the testimony for Powell and Brainard in front of the Fed, in front of Congress for the appointment as vice chairman. And, you know, when you read the testimony, you get a very good sense that Brainard is very much concerned about every American, not just average numbers. So when she says, you know, I want opportunities to exist for all Americans, or when she speaks about problems in the economy that hurt certain groups more than others, you know, she's not joking around. I think she really means that we need to make opportunities happen for everybody. And the part of the Fed policy is to think in terms of what the policies that the Fed has due to the different groups in our economy. So, for example, right now, like unemployment rate is back to 3.9%. And that's great, makes us virtually back to where we were before the pandemic started. When you look at unemployment for whites, it's at 3.2%, and it's still at 3.2%. It was at 3.2% before the pandemic. It's back to 3.2%. If you look at the unemployment rate for African Americans, that was at 6% before the pandemic, and now it's at 7.1%. So, the benefits of the easy monetary policy have not been distributed all that evenly. Certainly not, when it comes to marginalized groups. And clearly, they've benefited tremendously certain income groups too, who tend to have more equity holdings. Zero doesn't win.
Oh, sorry, Jim. Before we go on to zero to one, I have a bunch of questions about this. Because listening to the Game Master, because if we think about what's happened in the last, I don't know, maybe 3 months, it's been this realization that the Fed is a little behind the curve. It might be a good way of explaining it, but you might say out to lunch. And the market had been very focused on the idea that they were going to leave rates very easy for a long time because of what you just stated in terms of the different ethnic minorities and the different rates there. Do you think that has been thrown to the wayside wrongly? Like, is that what you're telling us, that the market is now saying that wasn't really that important, but we should still be listening to what the Fed is saying because they have not dropped that policy?
I think that you need to listen to the Fed, and what they're saying is that they're going to try and thread the needle. If they really want to slow the economy down in order to get inflation lower, then everybody is going to get hurt. What they're trying to do is slow the economy down in a very gradual and as little painful way as possible.
Okay.
And I think, that's basically what they're saying. That's their policy right now. They're a little bit concerned about, I think, what happened in the last 14 days where, you had relatively large moves. So the S&P hasn't really gone any place, right? I mean, it's probably down, 1% on the year now, but it's traveled probably 9%,
Yes.
Went up, collapsed, came back, moved back down, came back up. I think, we've had a lot of volatility, and I think the Fed's conscious of that.
Right. But I guess what I'm hearing is that although the Fed is conscious of that the market is probably not doing a good enough job listening to the Game Master, meaning that we probably will continue to see an easier Fed than the market expects because of what they're telling us about this unemployment. Would that be a fair way to characterize your view about this?
Well, it depends on what you mean by easier Fed. I think that the Fed would like to gradually move real rates back to neutral.
Okay.
And real rates are, now it depends which one you measure, but like say minus 75 basis points, and neutral is probably close to zero. So, we need to move real rates up 75 basis points. But what happened in the last 14 days is actually quite astounding. If you look at the 5-year forward real interest rate,
okay,
at the beginning of the year, it was 110 basis point negative.
Why don't you explain to people what that is, the 5-year forward real interest rate?
The 5-year forward real interest rate is the interest rate for 5 years starting in 5 years. And you can calculate that by looking at today's 10-year interest rate,
right?
The real one, minus today's 5-year real interest rate. And then you can calculate a forward 5-year interest rate.
And when you say real, that means after inflation.
After inflation.
Right. Okay. So
Correct.
This is what the market is expecting will be the real interest rate for the 5 years in 5 years term in 5 years time.
Exactly.
Okay.
And that was on January, whatever it was, 2nd, minus 110 basis points.
Okay.
Today it's at minus 67 or something like that. So we had rates go up about 40, what is that, like 43 basis points?
Right.
Now, 43 basis points doesn't sound like a lot, but the standard deviation of the 5-year forward real rates over the last 20 years has been something like 12 and a half basis points.
Okay. So this
per
was
week.
this right.
So it was a 3.5 standard deviation move. That's a big, 3.5 standard deviations is a big move. And, Goldman put out a piece 6 months ago about equities coming under pressure when nominal 10-year bonds go up by 2 standard deviations. At the time, that was about 32 basis points. And they were explaining why, stocks had come off, and they correlate it with the 10-year yields. And that's you can do something similar with real rates, and you can see that if 2 standard deviations on 10 years is enough to make the stock market nervous, then 3.5 standard deviations on the real rates clearly will make the market nervous also. And that's what we saw in the last 14 days, and that's, I think, why when the Fed was doing their testimony, they were not as aggressively hawkish as they could have been after, and that's, I think, why the 7% CPI number didn't really freak out the market either.
Right, because the Fed had backed off their hawkish testimony because of the increase in real rates, which was a larger than usual move.
Yes, I think that the Fed is not dumb. I think the Fed is very smart about knowing what is happening in the market, and they look at every component of the market, and they're seeing that we need to bring real rates back towards zero. But do we have to do it in a month? Like over 2 weeks, 40 basis points, then another 40 basis points the next 2 weeks? No, We've got some time here. So let's just kind of like back off a little bit. And you can see it also in credit spreads. Credit spreads moved 1 standard deviation higher, but then like even after the 7% CPI number started kind of coming back down. So at the final move right now, like high yield CDX is, up like a half a standard deviation since the beginning of the year.
Right.
But I think the Fed is caught in a really tough situation because we don't know what inflation is going to do, right? I mean, there are lots of people who are forecasting that inflation is going to come off by the end of the year. They have a variety of reasons. And there's a whole group of people who say, nope, inflation is much worse than we think because, we're not measuring housing price inflation correctly, et cetera, et cetera. And, we really don't know what the actual numbers will look like. So I think the Fed is just trying to leave itself as open as possible and hoping that they can gently thread the needle to bring the financial conditions index back to neutral. And neutral means that you want to get it back towards the levels where it was pre-pandemic, right? And if you look at the financial conditions index, do you know what the financial conditions index is?
Well, why don't you explain to everyone? And there's different ones as well. So which one do you like?
I mean, I think the easiest one to follow is actually the one Goldman Sachs has on their website. If you're a client of Goldman Sachs's, because they break it down very nicely to show you where the changes have come from to make something tighter or not. So financial conditions index measures how easy or tight conditions are in the financial markets, and they do it for all the countries around the world.
Right. And could you tell us what the inputs are?
Yeah, like Goldman uses short interest rates, long interest rates, credit spreads, the dollar, and the stock market. So they have 5 components. And, if interest rates go down, that means the FCI is getting easier. If interest rates go up, it's getting tighter. If the stock market goes up, it means the FCI is getting easier because people feel better and, it's easier to raise money. If credit spreads widen, it gets tighter. And if the dollar goes up, it gets tighter. And if the dollar comes down, it gets easier. So what would the Fed, well, if you look back to the beginning of the pandemic, or like a month before the pandemic, and compare the FCI to today, the FCI is significantly easier than it was then. And if you look at the actual components, the one part that is making the FCI a lot easier than it was, say in December of 2019, is the rise in the stock market. I mean, the other parts are not all that different. It's not as if credit spreads today are super more tight than they were in December 2019. They're actually very similar.
There's your friend is joining
my
us.
Dog.
But Jim, doesn't that imply, therefore, that the Federal Reserve is tuning to the stock market to some extent?
Yeah, it does. I know. I think they are probably very aware of this, and I think it makes the stock market a much more difficult bet than it was in 2020 and 2021.
So the Fed is trying to engineer tightening conditions to basically get rid of the excessively loose financial conditions without causing real pain in the economy. And one of the things that I don't know if you've noticed this, but I've always noticed it, is that you mentioned earlier that the Federal Reserve is not as dumb as they seem. And I completely agree that the Federal Reserve is probably more aware of everything that is going on and is not quite the dummies that everyone likes to make them out to be. But the thing that is different about Wall Street and markets in general and the Federal Reserve is the time frames. Wall Street thinks everything needs to be done now. Inflation's a problem. We need to fix this now. And the Fed operates on a much longer time frame. Would you agree with that analysis?
Yes, for sure.
Yeah.
I mean, they are, they've been around for a long time. They realize that their policy impacts with real lags. The economy doesn't react all that quickly unless you have some kind of a crash. Okay, that's different, or COVID strikes and the world has completely changed within a couple of weeks. But in general, policy changes take a long time to feed through the whole system, and the Fed's very aware of that. I mean, if they raised rates 4 times, yeah, will that feed through into the economy? Sure. But is that first hike of 25 basis points going to change anybody's behavior significantly? No.
Right. It'll affect financial markets more than it'll affect the real economy.
Exactly.
Yeah.
Exactly.
And so now one of the things that you alluded to in there is that the Federal Reserve is no longer the tailwind at our back, and it's in fact now going to be something that we should be worried about.
Yeah, I mean, I think they're more of a headwind now, right? So we need to be just a little bit more careful, which kind of gets me back to the third point of, the kind of bets that people make, when we were talking about
probability matching,
how you should approach the world. And, probability matching tells you that, well, you and I talked about it last time, that you really shouldn't be probability matching. You should just play the optimal bet, which is, the stock market's gone up 80% of the time in the last 30 years over the next year. So you should be betting that the stock market will go up unless you have some more insight into why this might be one of the 20% years. And, the fact that the policy, both fiscally and monetarily, is turning into a headwind is a fact that has changed significantly from 2020 and 2021. And so my edge on 1 year stock market view is not as strong as the baseline. I mean, you always have to start out with the baseline, right? You can't just kind of guess. But if it's 80-20 over 30 years, does it have to be 80-20 for this coming year when I know that the Fed is being a little tighter and definitely would like to slow inflation down? And I know that fiscal policy is clearly tighter. We don't know if we're going to get this Build It Back Better bill, or, we just don't understand what exactly is going to be happening on the fiscal side, but we do know that it's tighter than it was 2020 and 2021. We also know that geopolitically risks are larger than they were before. We see this military buildup in Russia on the Ukrainian border. I mean, we can't say there's a zero probability that there's not going to be a war. I mean, there could be a war. We just don't know. There could be a military incursion. And, as traders, we just have to leave ourselves open to thinking that anything is possible that we see in the world. And, so my next year's probability is not 80-20. I'm more in the camp of saying, well, I'm really kind of, maybe this will be one of those 20% years.
So
I've definitely reduced my risks.
So that was going to be my next question that one of my pals asked me to ask you is how do you manage to hedge your long equity risk? What does that look like specifically?
So I actually sold virtually all my cash equities and then replaced them with options.
Okay, that's interesting.
So
why don't you explain to us why you do that and what the thinking is behind that?
So the thinking behind that was that I want to be able to be absolutely in control of my downside. And if I have a call option, I know exactly how much I can lose. I can lose a premium that I paid for that option.
And would you typically buy long dated in the monies, out of the monies? What does it look like?
Normally I buy kind of 20%, 15% out of the monies if they are individual stocks.
Okay. And what would be the term of that? Are you looking 1 year, 2 years?
And normally I do 1 year.
Okay.
Yeah, sometimes 2 years, but a lot of 1 years.
And by doing that, in essence, you now have a situation where if we do get a crash, all you lose is the premium on your calls.
Exactly. And actually, if I measure my delta, I still have a reasonably large size position. The position hasn't gotten that much smaller, but I have an awful lot more cash in the bank.
Right. And was one of your thinking about that trying to take advantage of the skew that you're seeing in the marketplace? The fact that a lot of times we're getting that right tail is cheap because clients are selling calls, or do you not see that and that's not really a factor?
No, I think that's been a factor over the last 10 years. And it's actually, I think, a little bit less so because we've seen retail participate more in options call buying over this year.
Oh, okay.
I think the market is getting smarter about the cheapness of calls versus the expensiveness of puts. And when you think of puts, the put call skew, people pay up for puts, and therefore there's always a higher volatility for puts. And of course, the further out of the money you go, the further away from today's spot price of where the stock is you go, the more that volatility goes up. But actually, when you think about it, puts can only protect you down to zero, right? Stocks can only go to zero, but so they can go down 100%, right? I mean, a stock is worth 100, it can go zero, you lost 100. But it can also go up 100 or 200 or 300 or 400. So actually, calls are much better investments than puts.
Right,
because you have upside that is not truncated, whereas on puts you have upside that's truncated. It can only, like the stock can only go to zero.
Right. And so what's interesting about that is you said that the market has gotten smarter about this. Do you attribute that to the GME, AMC, and the blowout right tail moves that we've had, or do you think it's just a function of there's just a lot more demand for it?
Both. I think the GME stuff really showed retail traders who have become more important that there's real value in optionality. And then also there were a couple of very large trades from what I would think would have been SoftBank,
right,
who bought large amounts of call options on different technology stocks at different times during 2020 and early 2021. And I think that, altogether, it just kind of made the market realize, or made the market makers realize that, there's some value in that right wing of the call structures.
And the SoftBank, was that, do you think, driven by basically the same kind of thinking that you had, that you should replace your long stock with call options because you're limited?
I think not. I think actually it was just for leverage.
Oh, you think they're using it for leverage?
They could just do a lot more, and you need a lot less cash. Even if you buy a call that's slightly in the money, right?
Yeah.
Then you're still paying a lot less. So if you end up being right on that directionality of the underlying stock, your return on premium is going to be significantly higher than what your return would have been if you just owned the stock.
So, Jim, this is a great time for me to sneak in this question. I asked Twitter about what I should ask you, and Andrew Simon from Macro Hive reached out and he said, could you ask Jim what he thinks longer dated, what does he think longer dated volatility skew is most mispriced?
Ooh, is this a question?
Yeah. So what do you think is what would be a volatility or a skew that is the most mispriced on the longer dated stuff? And I think that you have a trade that you put on recently. I think maybe this would be a great time to talk about it.
Well, that one wasn't actually an option, but I think that's just a trade. But yes, we can talk about that.
Sure, but is it not the same that
it's the same idea.
It's the same idea.
It's the same idea.
Okay.
So basically the trade I did a couple of days ago was to buy volatility on the euro. So euro volatility is trading at about 5.7 for 6 months. In December, it was at 6.25. So for some reason, euro volatility came down. I don't know why. But at 5.75, it is at historically very low levels. I wouldn't be able to tell you exactly what decile of the distribution it is, but it's someplace in the bottom 20% for sure. I bought this volatility through a vol swap and paid 5.75, and it will settle in 6 months against what the actual realized volatility is over the next 6 months in the euro. So over the past 6 months, the volatility was 5.22. So if we just have a repeat of the last 5 months, I'll lose the difference between 5.75 and 5.22. So that's like 53 basis points.
Right.
It's not going to kill me. If the world came to a total stop, right, the most I could lose is that volatility is zero.
Right.
Right? I mean, nothing moves.
Yeah.
Right? It's not going to happen. Actually, the absolute lowest realized volatility over 6 months we've had in the euro happened several years ago, maybe 4 or 5 years ago, and it was like 3.83 or something like that.
Right. So let's assume that's the worst case.
So if we assume that's your worst case, you'll lose like 1.9% or something like that. But let's think about the upside. We're 5.75, and we have a military confrontation in the Ukraine. Where is euro volatility after that? I don't know. When COVID hit, euro volatility traded up, and it was in the double digits, like at 12%. So I think that we are in a world where volatility is too cheap and has been mispriced by the market in currencies, in the large G3 currencies,
right?
Not the Turkish volatility.
Turkish, those are
way off the charge. Yeah. That's a different story. But when you look at the euro, volatility here is just way too low. So I looked at, just to talk about how we do research, I said, volatility kind of transfers between markets. If one market's kind of unstable, it moves over to the next market. It doesn't just sit around in little silos and never move. It's people who are looking across markets and say, well, this is too cheap or too expensive, and I can hedge it with this other volatility. So if you look at something like the move index, which is an index that I think Merrill Lynch created to measure kind of the average volatility in the fixed income markets, right? It measures all the different kind of maturity buckets and then averages them out. And if you took the move index and the euro volatility, and you divided the euro volatility by the move index, about a year and a half ago, that thing was trading at 0.19. And you can do that on Bloomberg really easily.
Right.
And today it's at 0.07. So what we're saying is the move, actually it's the other way around. I had divided the move by the euros. But what happened is that the move index has moved up dramatically while the euro volatility has actually come off. And I think that, in general, volatilities are related across asset categories. They don't just, one doesn't go down and the other one goes up. I mean, we live in a very connected world and a connected economy, and people's portfolios are connected. And I think that it just shows you one of the reasons why I think euro volatility is so cheap. But I think it also addresses this whole idea of geopolitical risk. I think it addresses what the Fed is trying to do. So let's say the Fed really wants to try to slow the economy down. They want to thread the needle, and they want to do it really carefully and take their time and, try to not create volatility. All right, it might happen. There's some probability it happens, but there's also some probability that, we get some higher inflation numbers, people start freaking out. I mean, right now, if you look at 5-year inflation swaps, they're trading at 2.4%. So what the market is saying, in 5 years, everything's going to be okay again. We'll be at 2.4% inflation, and that's CPI inflation. So the Fed always looks at PCE, which is about 30, 40 basis points below CPI. So that's kind of right on Fed target, right? Like 2% PCE inflation in 5 years. That's where the inflation swaps are trading. So markets are kind of going like, the Fed's going to be okay. Initially, at the beginning of this year, those inflation swaps started trading also at kind of like 240 or so, and then started going higher and ended up at 263 early in January. And, when we started seeing rates, those 5-year rates go up by 40 some basis points, the inflation expectations actually started dropping. And that's why real rates really moved. So the inflation expectations, or the inflation swap, as measured by the inflation swaps, dropped from like 263 back down to 240. So inflation was like 23 basis points more controlled. But, if we get some number or the market gets nervous for whatever reason, like oil prices go through 100 and bad things happen, then maybe that inflation swap starts making new highs and going through 263 and suddenly is trading at 3. Would the Fed have to be more aggressive? Yeah, the Fed would have to be much more aggressive, because otherwise real rates would suddenly start being more negative. We'd have, even easier policy than we have today, and they would have to step on the brakes. And if they're going to do that, we're going to start seeing a lot more volatility in the markets in general. So I think euro volatility is mispriced for whatever reason. But I think also the idea is that you really can't lose an infinite amount on it. It can only go to zero.
Right.
Well, and on the upside, who knows how bad it could get.
And just, I guess one of the things you said, that volatility doesn't stay contained within asset classes, I completely agree. And the way it seems to me that this played out is that for a long time, the volatility, coming out of the COVID crisis was all in the stock market. Then as inflation took off and as there started to be more concerns about the whole Fed hiking timetable, we saw an increase in volatility in the fixed income market. And now I think that it's a logical, extension that eventually we're going to get volatility in the currency market. And I know that currency traders have been saying this for a long time, but I know lots of long-term people that have been in this sector that are saying that the currency vol in general is one of the all-time greatest buys right now. You're not alone in noticing that this is cheap.
Yeah, I think this is kind of the clearest bet I see for 2022 right now. I mean, I really see 2022 as a year where there's going to be more volatility. There's just more uncertainty. There is, when asset prices are going up and the Fed and the fiscal policy and every central bank around the world is inflating and creating liquidity and making things easier, it's not that hard to say, well, I should go with the 80-20 rule and stocks are probably going to be higher. But when the opposite is happening all around the world, we've had lots of central banks tighten in emerging markets, especially if you look around the world. Brazilians have tightened and lots of central banks have been tightening all around. It's just not as easy a world. And when it's not as easy, you should just kind of pull in your horns and think about what things could happen. And on the dollar, the other thing that we haven't at all talked about is like the current account deficit is now $1 trillion a year. It's the same absolute number that it was in around 2005, 2006, which was the largest absolute dollar number that we've seen in history. Now, as a percent of GDP, of course, it's smaller because in 2005 we had, much less GDP. So at that time, it was something, let's say, like 5.5 or 6% of GDP, and now it's only 3.5% of GDP or something like that. But that's a big number. We need to bring in $1 trillion worth of securities buying, foreign direct investment, money to fund a current account deficit. And, it in the history hasn't been terribly difficult. It's happened. But again, in a year like this year where, how much new money is going to flow into the U.S. equity market from foreigners when prices are relatively extended, and it's not that easy to say, we're just going to raise billions of dollars of foreign money, or bond yields might be going higher. Well, who wants to buy bond yields while they're going higher? That's when you just create a capital loss. You want to buy them after they've hit the high so that you can ride the yield back down again, so you get a capital gain. So I think the dollar is one of these things that could move a really large amount lower if we have kind of like a Fed issue and the stock market starts coming off and the current account deficit suddenly becomes something people talk about. Or it could go a lot higher if you have some military confrontation in the Ukraine, because then you have all the Europeans who kind of say, oh my God, I better have more money in the US. And the euro would probably be down at 105 and down 10 big figures. So I think this is the year where you want to just own volatility both ways. And I think these vol swaps are just a perfect way to do it.
Right. And for those that can't trade vol swaps, not all of us have a personal ISDA, but it also means that if you're right about volatility going up in euro, it means owning premium in the euro will also be a good trade. Most likely.
Yes. Most likely.
In general, it's obviously more complicated, and it's a lot more difficult. You have to pick the right strikes, and there's a lot more to it as opposed to just betting on the variance. But on the whole, it's cheap, and those options are cheap as well. Now, speaking of volatile asset classes, Ian wanted to know what you thought about crypto, and you were one of the fellows that actually bought a little bit of crypto worth 1% of your portfolio or something like that. And
I bought 3%.
3%. Well, that 3% must have turned into a lot more. So how have you been managing that? And what are you thinking about we call it the asset that shall not be named.
Baltimore.
Yes,
so,
that's right.
Yeah, so in 2019, I bought 3% of my assets. I put 3% into Bitcoin because I finally felt that the custody situation was not as dire as I had feared before. And, about 2 months ago or so, that was 38%.
Whoa.
And then, over the year, we had sold a little bit of Bitcoin to reallocate it to other things. So initially, when we bought 3%, it was just all in one thing. It was called Bitcoin.
Yeah.
And then I used the time to do research and learn new things about these crypto markets. And, I learned about other things like Ethereum and Polkadot and Solana and. It was endless. And, I slowly started selling Bitcoin and using that money to buy other things. And then in November, when we were at 38%, I kind of said, I just want to cut back a little bit. And we sold 8% of NAV, so we were down at 30. And then crypto markets collapsed and we lost 10% of NAV. So now we're down at 20.
Okay. Which is that's still a huge chunkier portfolio in an asset class that is, as I like to joke and call it, the bits in the sky. What do you feel confident? Is it something, if it goes down from here, would you be more likely to sell more, or is this something that
No, I'd buy more.
You would?
I'd buy more. Yeah. If it went, I hope it goes down from here, then I'll buy more because I sold 8%. I might as well, if I could buy and put those 8% back in and have twice as many coins, that'd be great.
So you have no long-term concerns. You're still riding the wave, and you think that it's still an attractive part of your portfolio.
So I think that all this crypto stuff is an incredibly great example of optionality. It can only go to zero, right? I mean, no one can make you pay up. I mean, unless you take leverage to buy it, blah, blah, blah. I don't take leverage. I just go out and I spend my money and I buy them. And the question is, how high can it go? And it's really very, very difficult to figure that out. I mean, I really don't have a good sense. I mean, people look at different valuation models and they say, digital gold and the gold market is worth $8 trillion and Bitcoin is at 1 trillion. So, if they both equalize, it could go up eightfold from here. And then there are, all kinds of stories. I mean, I look at it more as something different. So, I think markets are actually fairly smart. And in the world, we have about $120 trillion worth of fixed income and about $120 trillion worth of equities and about $10 trillion worth of gold and silver. So we have 250 trillion, and then there's real estate, but I don't even think of real estate as that tradable because people own it really to live in it. So it's not really like a financial asset that yes, it's a large part of your assets, but it's not something you're going to trade. So there are 250 trillion of assets, and then there's 2 trillion of this thing called crypto assets. So that's 80 basis points to 1% of all global financial assets. And like in an efficient world, you would want to own the market portfolio. So you should own 1%. Everybody should have 1% of their net worth in that portfolio. Of crypto should be 1% of your portfolio if you want to just mimic the world. And the world is not dumb. The world makes decisions based on trying to maximize their wealth, trying to do things the right way. So they don't always succeed, and people make mistakes, and they buy tulip bulbs and they go to zero. But it's also possible that crypto becomes 5% of global financial assets. And why not?
Jim, so when I hear that, I understand that argument, but what I find most fascinating is that you've bought this option, and I understand you put 3% of your net worth into it, and at that point, you're like, okay, if I lose the 3%, I lose the 3%. And I'm more interested in how you keep staying long when it's 38% of your NAV. And then even more interesting is that aren't you, when you sell some and then buy it back, if it goes back lower, aren't you therefore implicitly saying that you're willing to lose the 38% because you're almost treating it like it's still the 3%?
Yeah.
Yeah.
I mean, I think you're right. I mean, unless I really changed my mind on crypto, I am willing to basically see it go to zero. Of course, I could change my mind on any individual coin very easily. I could think that, what they call gas fees, which is what you have to pay to transact on the Ethereum blockchain, they've gone up a lot. And who knows, maybe Ethereum is just not going to work out. And, the market cap of Ethereum will go back to zero and people will only use, one of the other coins like Solana or Polkadot. They call them Ethereum killers. I could believe that, and then I would sell all of my Ethereum, and then I might not immediately reallocate it all to these other ones. I might just kind of go like, okay, I bought it at a good price, I sold it. Let me think about what to do with the cash next. But in general, I think it's really hard to hold on to good positions for a really long time.
Well, that was going to be my question. You bought a 100-vol asset, and when it's 3% and it's a 100-vol asset, it's livable. I can understand that. I can live with that. But you're still own 38%. Now you're down to 30 or whatever. But
I'm down to 20.
Well, you're down to 20.
I'm naked.
But
naked.
you were at 30. Like it's down to 20 because of a change in the price. But it's not an allocation reallocation thing.
Correct.
So you in essence were willing to have 30% of your portfolio in a 100-vol asset. Tell me, like, from an emotional point of view, how do you manage that? Because it's got to be gut-wrenching, and your vol of your portfolio has got to gone through the roof.
Yeah, I just relax and do some reading. I mean, honestly, I think that you have to try to step back and say, have I done my research right? Have I thought about why I want to own this, and what do I think the upside is versus the downside, and are things developing the way I think they were going to? Are there more use cases happening, like these NFT things? Is that real? Is that just BS? What else is happening in the world? I mean, are we getting more regulation, which I think would be good for the market? If the U.S. government kind of came out and said, you have to know your customer when you transact in crypto, it's great for me. I would love that, because that would bring in more and more institutional buyers. So I think that, your emotional state is driven by the kind of seriousness of the analysis that you did.
Well,
if you think,
Jim, I hats off to you, buddy, because there's no way I could sit through there, even if I believed in a trade that much. When it becomes that big part of your portfolio and that sort of volatility, I would just have trouble. So I don't know how you do it. I really don't.
I don't know. I do.
Listen, it's the way to real wealth, and you're not alone in that. When I've spoken to other investors of your caliber, this seems to be one of the overarching themes: is when you get a winner, you have to hang on. And everyone knows the famous saying that you let your winners run and you cut your losers short. But to me, you guys that are able to do that at that sort of level is what differentiates the good investor from the truly outstanding investor.
I think you need to be lucky. because it's survivor bias. How many of the ones who had this kind of attitude went under? Any business owner is basically doing the same thing, right? Their business, most of their wealth is tied up in their own business.
That's a great point. That is a great point.
They just keep riding it, and they work on it, and they try to do a better job with their business. In our case, we don't actually get involved in the business of whatever the investment is. But in a certain sense, we are business owners in this idea, in this trade. And, I very seldom, for example, sell long-dated options back out. So if I, during COVID, I had these 1 year and 18-month S&P digitals that absolutely got destroyed. But, I wasn't going to sell them. It was an option. And a year goes by, and then you look at them and you go like, whoa, they're up 3x. And, that was lucky. Maybe if we hadn't had the kind of rebound and the Fed hadn't been as aggressive and the government hadn't stepped in and had a big fiscal program, I would have lost all that options premium. So I think we just have to be humble about it and just do the best we can every day.
Well, that's fascinating. Now, you mentioned the fact that if you were just taking a market-based approach to allocating your assets, you should be roughly 1% in crypto. I'm curious about how you think about the whole trend of passive investing and what we've seen recently with the preponderance of more and more passive money pushing those, big 8 names up. And do you think that this is a change that is occurring, and are there opportunities for the non-passive investor? And do you think also that it might be the glory days of macro that we used to see way back in the Paul Tudor Jones days when currencies were all the rage and there was all sorts of volatility, all sorts of asset classes? Like, do you see a shift on the horizon in this, or is it just going to be a continuation of buy those 8 names and collect all your returns?
I think it depends on the silo that you're looking at. So that active passive thing is really something that happens in equity markets, right? You don't have a passive FX investor.
No, but you do get
right?
passive, increasingly passive fixed income investors.
Yes.
Yep.
It's all in the they're all in the real cash markets. Right. Where there are indices which are hard to beat over time. So there was an interesting paper that just came out, and I'll send you the link. But basically, they did research on what drives individual stock prices. And they showed that in the US markets, the market has actually become more efficient, even though we have more passive investment.
Okay.
So that was an interesting factoid, because I used to be of the view that, eventually you put enough money into passive and nobody's doing research anymore, there'll be more opportunities which will drive more people back into active, and they'll find those opportunities, and that's what will make the market more efficient. But I guess we're not yet at that point. It doesn't seem to have happened yet.
And one of the other things that I'm interested in, when you're thinking about your portfolio, do you compare it to any of the indices, or in your mind, are you just trying to beat cash? Like,
I'm trying to beat cash.
Yes.
I live on my portfolio.
Right.
I take money out every year. I buy goods. I buy a house. I make donations. And, I try to... So cash is really my benchmark. I just try to make money so I have more to give away. I think there's nothing that gives me more pleasure than supporting interesting projects.
Right.
So whether it's at a university or wherever.
Do you want to actually name any of while you're here, the things that you're passionate about? Feel free to give them a plug if you want.
Sure. Columbia University has something called Act Today, which is a program where Columbia's Climate Forecasting Center helps farmers in 7 countries around the world with climate forecasts. Now, Colombia has probably the best climate forecasting system in the world for 1 month to 13-month weather patterns. So, we can all forecast the weather. We look out of the window, and for the next 5 days, weather forecasts are great. And over 50 years, people have been pretty good at figuring out what's going to happen. It looks like we're having global warming. Things will get a little warmer. The hard thing is what happens in 6 months? We know, okay, it'll be warmer, it'll be summer, but how much warmer, how much rain? Colombia excels at that. And, they're working with farmers around the world on giving them the information that will allow the farmers to plant the correct kind of seeds at the correct time of the year. So plant them a little bit earlier because we expect a little bit more heat or a little bit more water or less water. And it's a program that's designed to help food security. And, I think food security is a super important thing in the world. We have just way too many people in the world, like 800 million people who are going hungry, who don't have food when they go to bed. It's just ridiculous. And so supporting this effort at Columbia University, you're supporting the scientists who are working on these climate forecasts or working with the World Bank to actually help the agriculture departments in different places to implement them. It's a great program.
Can I ask how you found it? Were you doing research on food prices for your portfolio and you stumbled upon them?
I was doing research on anything interesting Colombia was doing, and they started something called Colombia World Projects, which focuses on areas where Colombia feels they have a special expertise in the world and where they can actually move the needle. Where can they make a real difference? And, they had a couple of professors present different programs, and this one just took my heart away.
Nice.
Super exciting.
Oh, no, it's fascinating, and you're absolutely correct that it is. We take it for granted. There's here in North America, we have too much food and a lot of not too much.
Too much milk, for sure.
In aggregate, we have too much food, and obviously there's some that go hungry, and that's a different problem. But in aggregate, we have too much food. But around the world, this is an increasing problem, and it's a fascinating thing, kind of cause that you've chosen to support. One of the things that we were talking a little bit about research, Jim, and I'd like to embarrass you a little bit and tell you a story. After our last podcast, one of the fellows that I used to work with at the bank, at my old Canadian bank, he reached out to me and he says, "Oh, listen, I heard you talk to Jim Leitner, and such a great interview, and I loved hearing from him, and I have a Jim Leitner story to tell you." And I said, "Oh, sure, shoot." And he says, "Well, this was when he was a junior on the desk, and he was working on the hedge fund section of at our bank, and he was talking to different hedge funds, and the hedge funds do risk arb and different strategies like convertible arbitrage." And he said that all of a sudden I got this call out of the blue, and this fellow says, "Hi, I'm Jim Leitner, and I'm interested in this trade." And it ended up being that one of our tobacco stocks was getting bought, and it was just a straight cash deal, and it was a risk arbitrage that was trading at an extraordinary fat rate of return, meaning that it was almost too good to be true how fat it was trading. And you phoned him up and you were curious about why this was. And it ended up being that he put you in touch with one of the big risk arb clients in New York, and you guys went back and forth, and then you ended up doing a big trade, and you bought all this stock from us. And this fellow was very complimentary. He said, "Jim Leitner was just an absolute pleasure to deal with. I wish that all my clients were like this instead of the hedge fund foul-mouthed sharks that I usually talk to." And he had nothing but great things to say about it. But what I found interesting was that when we it's not something you actually do a lot of, in that I've never heard you talk about risk arb, and yet here you were phoning up our risk arb desk out of the blue and doing a big trade on this stock. I'd just be curious of what does your research look like that would enable you to see this trade, and walk us through what might have gone on through your mind when you kind of stumbled upon this opportunity.
Um, so that's a good question. I think that let me start in a different spot.
Okay.
So why do we do research? Well, when you think about what we do for a living, or what anybody does for a living, really is, you explore opportunities and you want to exploit opportunities, right? So let's say this happens to you that you want to, let's say you want to hire somebody, a new assistant to do research for you, and you get 100 resumes in, and you kind of know you got to look at these resumes and have people come in and interview them, and you either offer them the job or not. And you also know that if you don't offer them the job, they'll probably just walk away and get a job someplace else, so they're kind of gone. So now you have 100 resumes in front of you, and they're all kind of good. What's your strategy in terms of the interview process, in terms of how many should you interview? If you interview the first one, you hire them, well, the better ones might still be in the next 99, right?
Right.
And if you interview the first 99, then you have to hire the 100th, because the others are kind of like annoyed with you because you interviewed them and you didn't hire them and they went off. So unless the 100th is the best one, you're also screwed. So you need to kind of figure out how many should you interview to get a baseline to then make a decision about the next, about who you should hire of the ones who are still out there.
Okay.
Right?
I'm with you.
So what number would you pick?
I'm thinking it's somewhere between 10 and 20. Am I low?
Okay, that's actually you're low in terms of the actual math.
Yeah.
And we'll get to that. But you are where people are.
Okay.
People tend to explore for too little time. And research is exploration, right? We explore the world in order to then exploit the world once we've figured out some new trade, like this risk arb trade, or like the Eurovol trade, or something that we hadn't done before. We explore the world until we find the right thing to do, and then we exploit the world. So if you think about it like this, if there were only one candidate who sent you a resume, right, you would just hire that one candidate because you have no other person to choose. If you get two resumes, you could either hire the first one or the second one. It's a 50-50 chance that you get the best one, right?
Okay.
Now, the question is, if there are three, you interview the first one, and then you have two more to go. Well, it's like a 1/3 chance that any of them is going to be the best, right? What strategy can you use to improve those odds? And the strategy you can use, think of it like this, is that you interview the first person, and then you hire the next person who is better than the first person.
Okay. I'm with you.
Right? So if you have candidates 1, 2, and 3, and they walk in, you interview one, and then you don't hire them, and then you interview the second one. If the second one's better than the first one, you hire them, and then you have the third one just doesn't get the interview. So if you have 3 candidates, since you're interviewing them randomly, how many different ways can you interview 3 candidates? Right? It's 3 factorial, right. 1 times 2 times 3. So there's 6 different ways that you can interview them. So if you interviewed the best one first and you don't hire them, well, then, that's not going to work. So you can have, let's call them 1, 2, 3. That's how they're also distributed in terms of being good candidates, but you didn't know that ex ante, right? Yep. So if you do 1, 2, 3, well, then unfortunately you have to hire 3 because 2 is worse than 1, and so you're going on to the next one and you hire 3. You can do 1, 3, 2. The same thing happens. 3 is worse than 1. But, you end up hiring the third person who is number 2. Right. But if you do this and you line them all up, so the next iteration would be you start with number 2, and then you have 1, 3, right? So then you're hiring the best one because you're hiring you don't hire the first person, but you hire the next person who is better than that first person.
Right. Okay.
So you'll hire number one, who is the best. That's great. So then you have 2, 3, 1, right? So you interview 2, you don't hire them. 3 is worse than 2, so you don't hire them. So you end up hiring 1. So you hire the best one again. And now you have the other way around. You start with number 3, and then you have 2, 1. So you hire number 2, or you have 1, 2, and you hire number 1. So how often have you hired number 1? You've hired him 3 times out of 6.
Oh.
That's 50% probability of being right, rather than the 1/3, 1/3, 1/3 by randomly choosing. So this is super interesting. And if you expand that to like 100 candidates, the correct answer is 37%.
Oh.
You should explore 37% of the candidates. So now it's not only about candidates, it's also about time spent. Let's say I'm going to spend 100 hours doing research.
Okay.
Well, how much of that time should I spend randomly looking for really new things to explore, and how much of that research should be directed towards exploiting opportunities that maybe already have on the books, etc.? I use the same kind of like 40-60 rule, like 37% and 63%. So I want to spend, out of the 8 hours a day, 3 hours doing research that teaches me totally new things that I don't know about.
Okay.
Right? 37%. So that's how I explore the world, and I'm looking for new things. And then the other 5 hours I want to spend, I look at the screen, I read Goldman research. But, there's high quality research and there's low quality research. Low quality research actually brings in a lot of random ideas. It's like reading all these blogs from people around the world, or being in touch with all kinds of, news sources. I mean, it's just random stuff. You're just reading, or you're reading book reviews, and it's stuff that you don't actually know that it is going to come out to give you a great trading idea. But unless you have some random input, you will not be able to find really new trades. So the next step I tend to use is curation. I love having friends around the world. I love when somebody picks up the phone and calls me and says, "Oh, have you seen this risk arb idea?" And I go like, I've never done a risk arb in my life, but why can't you might as well teach me about it. And I'm sure that is exactly what happened in that Canadian trade, because I have never spent any time looking for risk arbs and keeping them on my screen and trying to analyze them again and again. It's probably much more driven by the idea that curation matters. We have so much coming at us every day that it's super important to have a methodology of cutting through the noise. And part of the noise is the 37% rule. Like for 37% of the time, I don't really care if it's that smart stuff or not. So, like as I was learning about crypto, I was just reading all these different newsletters, and I think some of this is just total garbage. But like if I know so little, it's still interesting to me. And then 60% of the time, I want to talk to people who are involved in their own business much more than I am. So for all my contacts and salespeople, I tell them, think of it as being an assistant trader. When Goldman puts out an interesting piece, let me know, because I'm on the Goldman email list and I have like 2,000 emails I haven't read yet.
Yeah.
I wouldn't even know which one to read. And I have 2,400 from Morgan Stanley. I was just looking. And I have 560 from Credit Suisse. And I just tell people, when there's really something that you feel is a super good, interesting piece, read it.
Yeah.
Then tell me, because I am not going to be able to parse through all the noise. And that is kind of how I found the Eurovol idea. It wasn't that I kept Euro volatilities on the screen. And even though I'm always involved with currencies, I just hadn't made that leap to, these vols are really cheap. But when one of the salespeople sent me a piece and said, you should really read this piece. I think this is really interesting. I read it and I called back and I said, what's the normal marketable amount that people do?
Yeah.
What's the
show me an
bid-offer
offer.
spread?
Show me an offer.
I said, look, I'm going to pay the offer. So, what is the bid-offer spread? So I know how much I'm going to lose on the first day when I market. I mean, we tend to mark things to the other side of the market.
Right. Okay.
So I want to know,
Yeah,
how bad am I going to feel tomorrow morning if I put this on? And I thought it was super exciting that that they did exactly what I'd asked them to do. Like, pick up the phone, call me when you see an idea that, I obviously understand that. She said to me, yeah, you did some of those with us in like 2019 or something. Like, okay.
I don't remember, but if you say
I don't remember,
but you know what I do? You know what I do, Jim? When I talk to salespeople, sometimes I'll say to them, "What do you own in your PA, your personal account?" That's what I'll ask them in terms of when you find a stock guy or a stock salesman. I'll say, "What do you own personally?" And often it's something completely different. It's not what they're recommending. It's not what the house is saying, but it's an interesting opportunity.
Idea.
Yeah.
Yeah. I say to them, what would you sell to your grandmother?
Right. There you go.
It's the same idea. But, I speak to people around the world. So I get people calling me from Australia. I get people calling me from Turkey, from Brazil, from the UK, from Germany, from Poland. And so, I get curation. I tell everybody, don't call me every day. I really don't need coverage. I can look at a screen myself to see if Euro Poland is moving up or down. But if you have a strong view that something is happening because the European Union is upset about the rule of law issues in Poland, and there's pushback, and they might not get paid the monies that are coming from the COVID relief fund, et cetera, et cetera. Well, if you have an edge, hey, feel free, pick up the phone, call me. It doesn't matter when it is.
Speaking of edge, you spent a lot of time in Russia, and that was one of your original stories that you told us. You've mentioned it a couple of times in our discussion so far today, the issues with Ukraine. I was just wondering, what is your opinion? Obviously, you've alluded to the fact that there's a lot of risk there, but do you have a view of how it'll likely play out, and if it is the market not taking it seriously enough?
I think the market is not taking it seriously enough. I mean, I'm no expert. All I know is what I read and I think about, and I look at people's blogs who are much better at this than I am, and I see that Russia has moved substantial numbers of troops into this area. I think back to the Cuban Missile Crisis, where we were willing to go to war in order to tell Russia not to put missiles that close to us. And, I have thought for a long time that it would have been a mistake to put somebody into NATO unless you're willing to actually go and fight for them. And so, ask when the Ukraine wants to join NATO, I think that's a super big step.
Yeah.
And if I were the Russian government, I'd be quite concerned. And, I'm just not sure exactly how this is going to play out. But I think the probability of risk-averse effects happening is higher than what the market seems to think. Otherwise, I think equities would be lower and the euro would be lower and the volatilities would be even higher.
Right. And you, one of the ways you've expressed that is obviously to own Eurovol. Is there any other trades that you've done?
Yes. I mean, when you look back at the correlation to equity drawdowns, there's only one currency that always appreciates, and that's the yen.
Okay.
When you have very large drawdowns on U.S. equities or global equity markets, the yen appreciates. It's happened every time when you have more than 10, 20% moves, the yen goes up. So yes, I'm long yen calls. I also think that yen is a cheap currency. So if you look at valuation support, you're getting it. I mean, if you look at the PPP kind of numbers, or the Big Mac index, or Goldman Sachs has something called GSDER, which is Goldman Sachs equilibrium exchange rates, dynamic equilibrium exchange rates, and they have dollar yen GSDER at like 94, and we're at 114.
Right.
So I think that, if there were a big problem in the world, dollar yen would drop 10 big figures. And again, options volatilities are just way too cheap. I mean, especially on the wing options. If you buy yourself something really cheap, like a 107 yen call dollar put or something like that, just doesn't cost very much.
I love that trade as well. I'm a big fan of Japanese equities. I think they're under loved and overlooked. And I completely agree that when the shit hits the fan, it always seems to be that the yen gets a bid. One of the interesting things that I found about that is that I read this quant book, and I can't remember the lady's name who wrote it, but she used as one of her triggers the yen variance swaps. And that was literally one of the inputs into her risk on, risk off, was to look at the volatility of the yen.
I'll have to pick that up.
Yeah, I'll get you the book.
I was going to add something. I was going to add something to your Japanese equity. So we actually are long call options on Nikkei and Topics machinery indices, because we did this analysis on the CAPE. How under the CAPE measures, all the stock markets in the world are relatively expensive. And then Schiller just started doing this ECY thing where he calculates the inverse of the CAPE, which is kind of like a yield.
Okay, an earnings yield.
Plus the real yields. And he looks at what is that sum.
Okay.
And so we do that for all the main countries around the world. And in Japan, that number is about 4.6 right now, which, so you take the CAPE, invert it, and Japanese real rates are just barely under zero. So, it basically gets you the inverse of the CAPE plus a little tiny bit. And if you look back at history, when the ECY has been in the 4 to 5% range, the Japanese stock market has gone up over the next 3 years, compounded 13.5%.
There you go.
So
giving me even more reason to buy it.
I know it's confirming evidence, and you should be looking for disconfirming. And someday we can talk about disconfirming evidence, but
all right, Jim. So it is getting towards the end, and we should probably wrap it up. We've already asked you your favorite investment books, but do you have anything new? Any new books that you might want to highlight?
Oh yeah. So this idea on explore versus exploit is a chapter in a book that came out about 2-3 years ago called Algorithms for Life. And there are 2 chapters. The first one is optimal stopping rules, like when should you stop interviewing, or after how many hours should you stop doing something. And then the second chapter is further exploration of this idea of how much should you explore, or how do you statistically correctly explore the world. So it's a great book. It's fun to read. It's not mathematically difficult. It's written for beach reading. So,
Jim, I don't know, when you say that Algorithms for Life is a fun read, it's kind of like me. I recently wrote a piece, and my father, when I was 16, handed me Inside the Yield book by, what is it, by Homer?
Kaufman. Homer, right?
Homer and Kaufman, right? Or Kaufman. And I joked and said, I think he just wanted me to turn out to be a Bond nerd instead of a Dungeons and Dragons nerd. Listen, Jim, it's been a real pleasure having you on. I really appreciate your time. It's always so enlightening and fun. If anyone wanted to reach out or learn anything more about you, where can they reach you?
Sure. My email, jleitner@falconmgt.com, or connect on LinkedIn, and I'm always happy to chat.
Great. Well, thank you again for all your time.
Take good care. Looking forward to doing it again someday.
Okay. We'll hold you to that, Jim. Take care. Bye-bye. All right, Patrick, it's time for Talking Charts. What do you got for us this week?
All right, let's go through the top 3 things we were watching last week. And we were talking about that momentum over value factor. And, both of us were convinced it was overdone and was going to bounce, so it didn't.
Of course not.
Once again, proving the fact that when me and you agree on something,
You gotta go the
all
other
our
way.
listeners got to do the opposite.
That's a lot of value add. People don't understand. It's hard to be that wrong.
But it continues to be interesting. Like, I mean, the Fangs rolled right over in the middle of the week, and obviously a little bit of a bounce to finish the week. But really, that rotation continues, and
exactly. We'll talk about it a little bit more. What was the number 2 thing we were watching?
The number 2 thing we were watching was the inflation numbers, which I guess
Hot.
they came in.
They were hot. I was wrong. I was expecting them to be a little on the weak side. I think one of them might have been slightly weak, but the reality was the bond market did not freak out about it. The bond market was expecting it. So even though
it's hard to surprise the market with inflation after the last 6 months, right?
Yeah.
Like
it was still all-time highs, though. This is an interesting dilemma, but okay,
you
number
know what?
one.
The question I was just going to ask you about that, though, right? Like with oil basically pressing near 52-week highs and potentially breaking out. Like, I mean, it's hard to imagine inflation rolling over until we see some sort of stalling in this. No. All right,
7. It's tough to stick at 7. I really think that it just as it rolls off, it becomes more and more difficult to keep that 7. I think that will be lower.
Yeah.
Anyway, number one. What were we
number
watching?
one? We were watching whether or not the bond selling would continue, and it did. It did.
You think so? Like,
well, look. Okay, so here's the 2-year yield. It didn't quit.
Well, but that's not. Listen, bond is indicating the long end.
Okay, well,
That's
5-year, almost at a.
That's still a note.
Okay, 10-year, almost right at the high.
Still a note. Let's go for the bonds. What were the 30s?
The 30s, I mean, they came off a little bit, but they didn't. But they came right back. I mean, this is the highest close we had from last week.
Yeah, they're not looking good, and they actually it was interesting today, even with the stock market weak on Friday afternoon. Bonds just went out at their lows. They're looking like they're sick.
Well, there's definitely the bond market has been under pressure since this year started. Maybe there's rotation there that was waiting for the tax year to end. You think that could have been a factor?
I think that a lot of people covered at the end of last year because of the Omicron developments, and that what they ended up going into year end too long, and this is more just getting back to where they want it to be.
Yeah.
All right. So you ended up writing the top 3 for next week without me.
Exactly.
So, God, there it is. I see the first one. You already said, like, when I'm not there
I had to squeeze in the. You're not going to be shocked.
It's going to, all 3 of them. It's going to be this one. We'll start with OPEX. That's the number 1 that you love talking about it, even though it's January.
Listen,
it's not even a quarterly, but we're going to put it in there.
It's not a quarterly.
Okay.
But I mean, the markets have been wobbling quite a bit, and the question, the gamma could pick up, and I think because the market is at this kind of fragile state, it's worth noting that if we get under gamma flip levels on the downside, I mean, it could actually create a volatile finish to next week. I mean, it's a shortened week already, and so it'll be worth watching whether the market behaves more like a pin or whether or not we have downside volatility.
So I will actually agree with you, but not for the reasons you think that we should put OPEX in here. And a big shout out to our pal, Brent Cachubo from Spot Gamma. He's been highlighting this. There is an awful lot of single stock options coming off in January. There is
all the leaps. There's a very large amount of people,
and there's a large positioning, and to some extent, I think we should be looking at this OPEX a little differently than we usually look at it, because usually we're thinking that the index is going to drive everything. I think that you should start to look at the individual stocks, and that you might see some action there. And on the whole, usually individual stocks, the clients are long calls. And so and a lot of those calls are deep in the money, so we could see some strange things happening there. So I'm not disagreeing with you putting it on there.
All right. Number 2, I want to talk to euro, because it's not about the dollar.
Yeah, that's right. You just, instead of putting the dollar in there, you just put euro.
Then we're definitely focusing on the euro. It just it needs to be crossed against something. It just happens to be the dollar. but we had a pop higher in the euro, and what was interesting is that for the last basically the back half of the 2021 year was a very clearly dollar strength and euro weakness, and the euro led the way all the way down. And really, December just looked awful. Like the euro had every reason to start a bounce, and it couldn't muster up anything together. And then here this week, we finally got that little punch towards the 115 level on the euro. And this is interesting because this is a fib zone on the upside. And what I'm just the way sort of copper faded off of its highs, or nat gas faded off their highs, I'm dying to find out. I prefer prairie dogs being along a high, but the same behavior prairie dogs do, which is like, will we see that this pop is faded on the downside, or is this actually going to mark a legitimate window from which the euro can strengthen to 117 or more? Nonetheless, a little bit of a price move this week, and I'm curious whether or not this is starting a new move in the euro, or whether it'll be faded.
Well, this is what happens when I let you do them without me getting in there. It's OPEX and then US dollar. What's number one?
Yeah, it wasn't the US dollar, it was the euro. Because it's not trade weighted into the Dixie. No. Anyway, so number one, does the market have another leg higher?
You mean the stock market?
Yes. And what's interesting about this is that obviously it's been a big muddle for 2 months, right? And overall, every rally seems to be faded, but overall, every dip is also being bought. It's kind of like a market that it's just chop. It's directionless at this moment. But the bigger question in my mind, you know what? There's an increasingly large amount of people that are starting to take a bearish tilt. There's a lot of people that are starting to believe that this is going to end in a bad way. And I kind of think, and I talk about it all the time, which is markets rarely drop when everyone is expecting it. And it seems to be like that everyone is so worried about this imminent market drop that I think like the most natural thing would be the market to wash them out with an upside move. Nonetheless, the market is in a very neutral stage. It's we're obviously going into an OPEX, chopping around in a range. But what I'm curious about whether or not this has the potential still to kind of make a fresh new high. I know Andy talked about it in your interview last week. But is there still one more leg to 4,900, or maybe that beautiful round number 5,000 on the S&P before this has a bigger correction?
I just want to know, Patrick, did somebody tell you that Andy said that, or did you actually listen?
I actually listened.
Well, it's only because it was Andy, not me. I think that's a great point. And one of the things that I like to highlight is that although we've had chop and we haven't gone anywhere, there's been within the market huge rotation.
Okay,
huge,
I'd love to show a chart on that.
Okay,
let's continue. Well, let's talk about this. This is the percentage of stocks above their 50-day moving averages. And what's particularly interesting is that while on the S&P and particularly on the Nasdaq, we saw us break below the November and December lows on the Nasdaq, and S&P kind of went and approached that level. When you look at the NYSE and you look at the breadth of the market, it's actually been improving. And that's a part of your rotation comment that you just made there. So what we're seeing is obviously some of the fangs are under pressure and some of those big boys are thing, but actually the breadth is improving.
Hey, by the way, wasn't it you that told me that we can't have a correction in the fangs without the whole stock market going down?
Yeah, but the stock market has, well, I just, well, first of all, I don't think that.
Stop. Now I'm probably going to probably going to cause a crash.
No, but let's be clear. I don't really call what the fangs have done really a big market correction. Yeah, they've been relatively on the weaker end, but let's not call that they're wiping out. Like I'm thinking like, okay, look, if Apple's in the midst of a 20 to 30% market correction, I honestly think that will affect the indices. But if Apple's coming a couple dollars off its highs and not participating, that's not going to drag the index down.
Well, I'd love to see. You want to go through those 8 names? Let's just look at them.
Yeah. Okay, sure. Let's take a look at all of these different plays. So let's start
Apple?
with no, we'll still go on Facebook first, right? And Facebook really has just been in a sideways chop.
Okay.
Right? And it's holding fib zones along 320. I mean, if it bursts back toward 350, 360, it actually wouldn't even be that big of a shock. But then let's
that chart looks fine.
Yeah,
it must be because it's the metaverse. It's the future.
Yeah, it's the future. So then you take Apple, right? And Apple, while it's certainly not been going up, I mean, it's more or less been in a trade range for over a month, chopping on the top. And there's no big...
Yeah, no, agreed. Okay.
Now, where there has been some weakness has been Amazon. Amazon not only had that huge pop in November to retest its previous highs, but has been basically distributing since. That's
because Jeff is out partying on the town.
Yeah, I think that shareholders are trying to punish him for having too much fun.
Exactly.
Get back to work. But it's trading to the bottom of the range. It'll be interesting to see whether this actually causes a bullish reaction. Because if, in fact, it's not, it could very well be that just Amazon remains in that same 1 year chop that it's been all of last year. It's neither gone higher nor lower. It's just been churning back and forth like a ping pong between support resistance. And the question now is, well, if that stays true, we're definitely approaching all the key previous lows and support lines. Will this offer a reaction on the upside of Amazon? And that's certainly worth watching. Then we could talk, let's talk Netflix and NVIDIA. We'll talk about the ends. So like Netflix, let's see, here we go. There we go. Now this is interesting, is like Netflix has been just getting murdered on the downside.
I didn't actually realize how bad that was.
Yeah, but it's approaching some key lows. This 500
Well, not only
level.
that, today I don't know if you were paying attention or you're too busy partying in Houston, but they announced a price increase and actually
it reacted positive and gave it back. It was actually interesting. I was with trading with my members and we were thinking of doing a put sell on it in the middle of the day. I said no, and literally 5 minutes later the news came out and popped. It's like, what?
Well, that's why. That's why.
It's
did it end up? Did it end up? I thought it went out at the highs. Did it not? Am I wrong?
No. Look at the chart.
Gave it up.
It gave it up, right? Like, but whether it gave it up or not, it's coming up to some pretty heavy support of previous lows as it finishes these little zigzagging moves. I actually think now, while I don't want to call a new uptrend and a major new buying opportunity on it, I do think that it's going to stop selling into this 500, 520 zone, and at minimum, it's going to trade sideways or maybe give a reaction back to 550.
Okay.
So I think it's just very oversold, and we'll get a bounce of some sort. I don't think that constitutes a new bull trend anyway. But
the NVIDIA,
which is it's again almost like a uglier version of Apple, which is it had a really great bull run, but and it's more or less coming off of its highs, but it hasn't really been getting murdered.
It hasn't been getting murdered, but it doesn't look good.
It doesn't look good, and it has lost all its upside momentum, no, for sure. And let's take a look at Google. I hate calling it Alphabet. I don't think I'll ever be able. I'm
the same way.
Like, I don't think I could ever call a Facebook
Metaverse.
Yeah,
I'd rather not trade it. I'd rather, like if you're going to call it Metaverse, I'm not trading it. Such a stupid name. Like, what do you think the over/under is when they're changing it back? It's like New Coke.
No, they're not
It's going to last longer than New Coke, but not by much. That is the stupidest name I've ever heard. And anyways, don't get me started.
I wonder whether they had some sort of focus group and just a bunch of people basically say, "Oh, that's a great idea." Like,
yeah.
Nope. Anyway, but Google similar. It's been overall the FANGs have been struggling. This is the whole theme that I'm trying to get across. Other than Netflix, really, the majority of them have been more or less coming off their highs.
We should really do FANG M with the Microsoft.
Yeah,
Can you do Microsoft too?
Yeah, for sure. We can look at Microsoft.
That one's actually weaker. That one's not
Microsoft definitely faded off.
I hear you. So what your argument is that this isn't really, although they're off, it's not really any sort of catastrophic.
Well, yeah, but like
decline
if you look generally on the Nasdaq, right? The Nasdaq is more overweight those fangs than the S&P 500, and let's say I throw on like a 50-day moving average on here, you can generally see not only did the Nasdaq make a lower low than its November December lows, but it's failed at its moving averages. Overall, the Nasdaq is underperforming the S&P.
Yeah.
And that is reflective of the fact that the fangs are under the pressure. But the point back to that breadth is that the breadth is actually thing. Like the financials are doing well, the energies are doing well. Many resources
they're
are doing well.
screaming.
Yeah.
Did you see them today? They're going out at their highs. It's crazy.
Yeah. And in fact, I want to talk about these energies. This is one of the things I prepped up. So let's look at the XLE. Let's take a broader thing. Like look at the way these energies are ripping. But what's interesting about this move? All right. So we have oil approaching its previous highs, depending on whether you look at the Feb contract or whether you look at the continuous. The continuous contract is just coming to its highs. But the Feb future actually made a higher high on oil. But oil has had a great run. I mean, we tacked on almost $20 on the upside in a span of 3 weeks. All right, it's been a great run. But I asked the question whether this is almost too much too quick. And one of the it's not that I don't we talked about last week of I think that oil could go to 90 plus, and you wanted to pass the baton and have me take that
$100.
But what I wanted to show is looking at the bullish percentage index on the energy sector. Just looking at the energy sector basket. And this kind of always reflects the overbought and oversold states of in this case, the energy basket. And here we are at trading at 95% on 5 occasions in the last 2 years. We hit 100%. So we haven't hit 100% yet on this, but we are definitely within a stone's throw of this overbought thing. And almost every time we've gotten to that stage, some pause in the market trend and some sort of market correction ensued. Now, this is not a short-term market timing. This could still run for another couple weeks, but there isn't much asymmetry in chasing energy from FOMO here. I think a lot of these moves, the easy money is now rear view, and you're just grabbing at the last few next impulses higher. That still could make some money. I don't think it's necessarily my call that you should pull the plug, but I'm starting to think that if you're a short-term trader versus a long-term investor. A long-term investor, I still think there's a potential throughout much of the year. But as a short-term, I would be starting to lock in some gains into this run.
I like it. You actually have a view, and you're sticking with it. And it's got to be wrong because I actually sold a little bit as well today.
Oh, don't gooch.
I only sold a little, though. It was very little. I just had to sell something because I was like, oh, Jesus, look at how – you know what scares me? I didn't realize that there's actually a sentiment index for just energy, but I can feel it. Everyone is long, and everyone has just made tons of money. It's been a great trade, and there's nothing wrong with it. And I agree as well that if we look at it on a long-term basis, if you're someone that's holding something for a year, don't think about it. Don't try to time it. But if you're someone on a short term that's trading it, it's
when you make this much money this quickly, you gotta take make sure you don't give all of it back.
The only thing that would be even more worrisome is if people started to give like oil barrel eyes. I'd be like Kramer in the episode, where the master of your own domain. I'm out. That would be it for me. That would be my signal.
Yeah. All right. I wanted to just touch on copper. I was looking for a breakout of 450 for a signal to go long, and I think I goochered it by mentioning it to you.
Well, I bought it as well.
Yeah,
I bought it like an idiot, like a chump.
But listen, I actually don't think the story is yet dead. and this is what I think. Maybe I should have put this in the top 3 so that you wouldn't bust my balls about putting the euro. But one of the things that I think is going to be interesting is generally, I think you can literally use the 450 level as a pivot. I think that if we come in next week and this little selling that we saw today gets back above 450 and generally holds at these higher levels and works its way higher, that it's still game on. What would be really disappointing and what would make me think that it was a prairie dog kind of false start would be if we faded and broke those last week lows. I actually still... I actually still think you could give the Bulls the benefit of the doubt here.
Listen, I actually bought more today, so like a chump. I don't know.
Oh shit! Stop agreeing with me. This is not
exactly. Good. That's not good.
This is. Look at all the warning signs we're giving our listeners. Yeah. Everyone's like
value add. Okay, what else you got?
Well, you know what? We might as well touch on uranium here, and this is interesting because. It has done nothing wrong, but it just hasn't broken out. There's so many of these things that are just breaking out and running, and uranium just doesn't seem to want to get any love.
I don't know. I look at that. That looks fine.
It looks fine, but the thing is that other commodity markets are all breaking out and ripping, and why is it?
So.
Why?
Give it
look,
time.
It had Kazakhstan as a catalyst, and like even whether you really agree that it really was going to affect supply or not, it's still a catalyst. It's still something that was an advertisement to the community to go throw some money in and get this thing going, and it hasn't moved.
Yeah, listen. That's a valid point, but I'm not that fussed about it. To me, that's just kind of noise as it goes around. That's the way uranium is, and then all of a sudden, what'll happen is over a space of 2 weeks, it'll double on us again, and that's just kind of the way it trades. It's difficult. It's not a good trader. That's what I believe for sure.
Now I just have to say, like I don't have a trade in here, but I have to say I'm a deer in headlights and watching lumber going parabolic all over again.
We spoke about this, didn't we? Down there at 600 or 500, it's kind of crazy. This thing went from 400 to 1,700, back to 500, and now it's back to 1,300.
But more importantly, it's rising in an accelerating slope, which is essentially like it's getting bubblicious again.
Bubblicious.
But you know what? What is a surprise to me is that usually after you have a blow off top and such a deep mean reversion in what we whether we call the Eiffel Tower formation, when you have that, usually the market stays dead for a much longer period of time before speculators get the appetite again to run it. And the fact that we are literally less than a year off of the high that they got it going all over again.
Yeah, that's a great point, Patrick. That really is. Yeah,
I'm surprised that it happened this quickly. Like even Bitcoin, when it blew off its previous high, it took years before it went and made the next parabolic move to the upside. I'm just surprised it happened this quick. And the fact that it's a deja vu. Like I can't believe we're talking like this thing could be at 1,500-1,600 next week. Like this thing is just crazy.
You're comparing it to Bitcoin. It's because the lumber doesn't have all the FUD, fear, uncertainty, and doubt that people are spreading about it.
All right. Well, listen, I want to just mention a couple of global indices. First of all, emerging markets came to life this week.
Oh, God, don't Goocher this for me, please.
Well, I'm a macro market observer like you. I can't. If I can't talk charts? You got to give me the list of things that I'm not supposed to touch. Well, anyway, what is interesting? Like, okay, so let's break down emerging markets in a sense that when you go to let's say India, Bombay market, like let's say the Sensex. This thing, after a 2-month consolidation, 3-month consolidation, is just back in running. Like while it's approaching its previous high, and there's always a chance of a double top, the thing is it's got great momentum. Like I would not be shocked if we see a fresh high and another push on the upside of India. But then take China. This looks like shit.
Yeah. So actually, sorry.
No, okay. No,
you
I'm going to make the
don't
point.
read my things because you didn't make fun of me for the India. We're not going to talk about India anymore because I don't want you to say anything more. So don't mention India again. But did you notice how many people got bullish on China this week? Lots of really smart people are getting bullish on China. And I have this thought, Patrick, that yes, China is going to stimulate. I'm wondering if the actual play is to buy the rest of emerging markets as opposed to China.
Ex-China.
Yeah.
I'm not. Let's talk about that. But when I put let's say China, this is the A50, of course. Like there's different baskets in China. But when I look at this weekly chart, obviously in 2020 was this great run on the upside on the China A50. And it went through a market correction. And back in the summer of 2021, based on the kind of oversold conditions there was every reason why we could have seen constructive, turning in the price action on the index. And it struggled. Obviously, there's some fundamental stuff and a recession in China and other things. But the thing is that it tried to break out in December, and it was immediately faded. And we're now trading at multi-month lows again. It hasn't broken the 2021 lows, but this is a very distributed market. And if some people are pumping it, I'll tell you, there's not much technical supporting it. I mean, the most they can hang on here is that support will hold along the previous lows in turn. But really, this chart looks like shit.
Well, I came to a conclusion from just a risk perspective. I thought to myself, I think there's better trades out there than China, but I could be wrong because there's a lot of smart folks that have recently put on a long China trade, and we'll see.
So I want to move on though to Brazil. I mean, let's just tack this one in there. Now, Brazil has been getting shellacked for the last 6 months. It's been a massive underperformer and a very distinct downtrend, lower highs, lower lows, just being distributed. And for the first time, it seems to be putting in some sort of it stopped going down. Let's not call it an uptrend. It stopped going down, and it's trading sideways.
What was your line they used to have?
Which one?
You had some line about it stopped going down, and it was I can't remember it.
Anyway, all right, but I don't know offhand, but I'll come up with it. But the point being that what's interesting is that when you look at two of the bigger components in Brazil, like Vale and Petrobras, they're both actually turning up. And they're working, and so the question here is that especially if that theme on Omicron, that this is actually a good thing in the bigger picture, and that we might be seeing easing of this COVID impact on emerging markets. I wonder whether this is enough selling where Brazil will also bottom, and that's. I thought I don't want to get overly bullish on Brazil yet because the chart hasn't really turned bullish, but I'd be looking for a bottom here. It might actually work.
It's funny you mentioned Petrobras because my old man is a little bit of a yield hound as he gets older, and he's gone and he's been long that thing for a while, and he was just mentioning to me yesterday how for the first time it's starting to perk up and it's starting to look a lot better.
Oh, let's take a look at it. PBR.
Yeah,
it's
there you go.
I
think it has a monster yield.
But it is getting all the energy tailwind, right?
Sure.
Everything in this space.
And a well-known friend of the show with outspoken views has told me that they're just returning your own money to you, and it's not a real yield. Who knows? It's one of those things that you won't know until many years. But in the meantime, people are buying it.
Yeah,
the Valet looks good.
Yeah, not looks good, but it was murdered on the downside. It contributed heavily to dragging the index down, and we're finally seeing that some sort of a tradable low is in. The question here is this a bigger turn in in iron ore in general? Like, look at Rio and BHP. It really. is starting to look like that very oversold iron ore space is obviously coming back to life. Well, obviously everything from nickel, copper, iron ore, steel, everything seems to be working. Like, how about the Canadian darling Tech Resources, right? Like, what a run this thing is having, right?
That's actually a great looking chart.
Well, I think that this is the same story as energy, though. Like, this is when you say great looking chart, doesn't make it a asymmetric buying opportunity here. Like, this thing has already made a huge run. I would very much like energy stocks. If you're a long term trader, I wouldn't do anything. But if you're a short term trader in this, it's starting to become a level where starting to take some off the table might make sense.
Okay, well, there you go. You heard it.
Anyway, all right. That's enough talking charts. Let's. Is that enough? This is okay?
I think that was pretty good. Thank you very much, Patrick. And you didn't ask me my sign, so I was really happy.
What's your
all right,
sign?
folks.
What's your sign?
Yeah, what is my sign?
All right.
All right.
Skin in the game, buddy.
Who won or lost? I don't even know.
You did, because I was trying to clip you, and you decided to hedge your own bet.
Oh, this was the asset that shall not be named.
Yes, the asset that shall not be named, over under 41.50. And, I had to take under because you demanded to be over.
Yeah, because only, as I explained, because I was...
You were hedging your own shorts.
Yeah, I was just... And because I thought about it, and I was like, I'm going to for sure lose if I just add to this. And so now I won a whole whopping case of beer.
Yeah,
is that what I won? So
no,
was it a case of beer? I lost
Lena,
all
was it a case of beer or just a pitcher? I think it was just a pitcher.
So it's not very good. Okay, so listen. Let me explain to people skin in the game.
Yeah.
Skin in the game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke, a pint of beer, a burger bet, a pitcher, case of beer, affectionately known here in Canada as a 2-4, a bottle of wine with a $100 limit, and the steak dinner. The winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no negative positions. So I'm not ready, and I just realized I got to come up with a bet, right?
Yeah, and
let's do the Euro. You're a big Euro fan. Pull up a chart. Let's do it.
All right, let's do this. There it is. We're at 114.
So I'm going to not be fancy. I'm going to be like you, up or down from here.
I'm taking down.
Okay, we got ourselves a bet. Okay, now what do you want to do? You sound like you're
case of
pretty
beer.
Case of beer. Let's go for a bottle of wine.
But no box wine.
No box wine.
Unless it's the one that Kuppy recommends.
Yeah, Kuppy's trying to convince us that it's actually fancy and then really much better in the box. Okay. Sure.
Yeah, sure.
The shrewd hedge fund manager that's trying to convince us that the box wine is really better than the other ones. Maybe he's right. Maybe he's a true value investor, and that is the much better.
Well, you definitely are getting value in the box. The question is, do they box the really good wines? They don't really.
Yeah, some are oak barrel. What is it? Oak aged, and then some are cardboard box aged. That's the ones that we're having. Okay, so what are you going to do? So we're doing a bottle of wine.
Yeah, we'll do a bottle of wine. I'm totally
okay. Give Lena the number there.
We're doing just do 114.14.
Now, for those who don't know, Patrick loves rounding against me when it comes to choosing.
What is that? Is that not 114.14?
Yeah, okay, but the extra digit, which way you go? Anyways, Patrick always rounds the right way for himself, and so we're hoping that one of these times.
No, I did it this time. I rounded in your favor.
Oh, did you? Oh, that's very kind of you.
So look at you, like throwing cheap shots at me.
I am throwing cheap shots at you. Okay, let's get Lena on here to improve the show.
Time for, but
all right, time for no stupid questions, Lena. Welcome.
Thank you.
Okay, you got to stop laughing so you got to read the first question.
I know, I got to read these questions for you guys. Okay, so first question. Hi, guys. Very educational show. I think this listener's writing into a wrong podcast.
that's
Question for the option experts. You have explained how option dealers hedge their option book for short option positions acquired when they sell options to customers, delta hedging in parentheses. My question is, how do the dealers hedge the positions they acquire when they have to buy, for example, an out-of-the-money call when a customer puts on a covered call, or spread trade involving selling a short option? It looks like the dealer would be on the hook for the complete loss of the premium 75% of the time for a 0.25 delta call, for example. Even when the option finishes, quote unquote, in the money, it may not be enough to cover the lost premium.
Okay, so I'm going to handle.
Let me just make a first comment. I'm going to let you actually answer the majority of it. But the one thing that is just important to consider is that what this investor is doing is isolating only one leg of a position the dealer has, and not looking holistically at the overall holdings of the entire book. As many of our, whether it's Brent or whether it's Jem that come on to the show and talk about this, often dealers have a lot of short puts with with a series of those long calls. So on a theta basis, they're relatively neutral. So they're mostly hedging delta on that. Am I correct in the way that I've started?
Well, you are correct that they put it all together. And that when they're looking at their book, they don't look at a specific line. But even if it was just one specific line that they owned, that was so this listener is asking us if they end up having to buy an out of the money call, and then the stock doesn't. So they're long the call, they're short the stock, and then it doesn't rally enough. He's saying that the dealer's not going to make any money. What the listener needs to understand is that the act of delta hedging means that the dealer is long gamma. So therefore, as it approaches the strike, they're able to sell more against their long position. And as it moves away from the strike, they're able to buy back against their original position. So in essence, what they are hoping for is that there's lots of volatility. It'd be better if there's volatility through the strike, but it doesn't necessarily have to be that way. It could be up until the strike and then back below and various things. But the point is that because they're hedging every day, that you could have a situation where it never goes into the money, yet it goes up close to it, then collapses, they cover it, then it goes back up to it, and they short some again, and then it collapses again. And that trading, that delta hedging, will pay for the premium that they owned. So it ends up being how volatile the stock is during the time of that option, and it's a little more complicated because it's around the option as well and around the strikes. But that's in essence what. You okay, Patrick? We lost Patrick. He's off the seat.
No, I think he put his headset down.
Does he have to go to the washroom?
I don't know.
You know what? Let's okay, this is what you're gonna do. Because it was so loud and he spoke in there. Let's just leave it in.
No, because I just usually any noise like that, I take it out. Like your heavy breathing. I take all of that out because it's
my heavy breathing.
Yeah, when you're interviewing Jim, all I can hear is I was like dying.
You gotta leave all this stuff in. This is gold. Okay, so funny. Patrick, are you there?
Yeah.
Okay, so we're gonna leave this in. We're gonna just leave the. Clean it up, but leave it in. Patrick just takes off. All of a sudden, we hear this clunk. Okay, so the long and short of it is for this listener is that the volatility can make up for it even if it doesn't finish in the money. And that's the important part they need to realize. Let's go on to the next question.
Second question here. Hi, guys. Best wishes for 2022 to both of you.
Well, both.
Whoa,
they missed
that's
Lena.
kind.
I mean, I don't know. They didn't say names.
The three of
so
us.
Maybe it's
That was
just
no. It was the two of you. No, it's the two of you. It's clearly not me.
Yeah.
Up for
it's
debate.
Okay.
Big fan and many thanks for the episode with Andy Constant. Super cool to hear from an old timer like him. My question is, as a personal investor, what benchmark would you use? I'm asking since it's good to keep yourself honest and also so your family can hold you accountable. However, there is a lot of choice, and benchmarking to the S&P 500 or the 60/40 doesn't include the popular alternatives like crypto, nor the biggest one, real estate. My current approach is simply beat bonds, negative yield in Europe, beat inflation, and don't be too far from where the S&P is on a yearly basis. I am wondering if there is something better out there. Many thanks.
So it's a great question. It's funny because I actually asked Jim this very same question, and Jim says he's just trying to trade on an absolute return basis. I am the same way. I don't care if the S&P is up 50% or down 20%. I'm trying to make money each and every year, and I don't bench myself and have an allocation to that. I'm trading on an absolute return basis.
So that's you. But so put some context. So when you're an active investor and trader and you're willing to go long and short, what we're doing is we're exactly trying to create absolute returns through our own trading methodologies. But I think benchmarking is more for portfolio building rather than trading. Right. Okay. And so if you are constructing a basket of investments and you're trying to kind of see how you're doing, that's where benchmarking comes in. And particularly, I think benchmarking comes in when people are trying to judge asset managers that are managing their money for them. Is the manager creating alpha? Am I getting
but
something?
this listener is trying to decide when
for themselves.
When they're looking at their own portfolio or their own performance, and they're trying to do it.
And this is where I was going to agree with you that, like, if you're not judging an asset manager and you're trying to benchmark them type of thing, I think what you're trying to do is construct an overall portfolio that is going to participate in the markets that you are comfortable in investing in. I don't think you want to almost like if I didn't beat the benchmark, but I really loved my investments, does that mean I have to sell them? Like I think that generally, if you're not being maybe I'm wrong, but like I just think that overall the need for benchmarking is less necessary when you're managing your own money.
Yeah, and I would push back and say I wouldn't worry about the benchmark at all. I would worry about the returns versus the volatility. If you have a portfolio, you start at 100, it goes to 150, then you're back to 40, and then it ends up at 110, and you say, great, I made 10%. That's a lot different than having a portfolio that makes 1% a month and ends up at 12.
So you're basically like saying use a Sharpe ratio.
Right. Of something of that nature. There's the Sortino ratio. There's different ratios to do. But the important part of it is that look at more than just the absolute the returns and look at the volatility. Because to me that means so much more than just
absolutely. Because if you throw in let's say you have real estate, you have bonds, you have equities, you have crypto, you have this and that. You want to basically look at what the overall volatility of your basket is to kind of reflect on that. I want to adjust it in some degree or another. That makes complete sense, by the way. All right, so let's go on.
So last question here. This is actually from one of your Macro Tourist newsletter subscribers, I believe.
Oh, nice.
Longtime listener, first-time emailer. With the ending of the previous QE cycles, treasury yields have declined, which is somewhat counterintuitive. I know, Kevin, you have written on the subject before, and I expect this time will be no different, even with a few rate hikes. Given my bias that longer-term treasury yields will decline over the next 3 to 6 months, what are your thoughts on miners, gold and silver? It seems to me that lower treasury yields would make these real assets, miners, more attractive, given how cheap they are and because they have some actual cash flow. What are your thoughts on these, the most disappointing of all stocks, stupid miners? Thank you.
Okay, well, great question. We won't even bother talking about the interest rate aspect of this discussion because I don't think it even matters. If you think that interest rates are going to head lower, you should go and trade interest rates. They're two completely different trades. However, I will agree, the miners are stupid cheap. They are so cheap. This is a great basket. I think Ronnie Sturfully from Infinium, is that how I say it, Patrick? I believe I got it right. He has this great chart that shows the free cash flow of these mining companies. It's astronomical. They're hated. No one likes to own them. everyone's disappointed in the performance of gold and by extension the miners. I think it's something where there's very little speculation. It's one of the cheapest sectors out there. For me, I own them. I'm not even thinking about them. I continue to buy them. I think that you'll wake up 3-6 a year from now.
So they're only stupid because they haven't been going up, these stupid miners, right?
Yeah.
They're only stupid because they haven't decided.
They're stupid because they haven't been going up, but they are cheap. There's no doubt about it. They are cheap, and it hasn't captured the public's imagination. Everyone's been fascinated with the crypto story, so nobody wants to own gold, nor the gold miners. But I think that story is going to change, and I expect that the gold miners is a great place to hide, and it's a great investment, and I continue to own them, and I love the theme. How about you, Patrick? Do you own them?
Way too many. But now we're butchering it.
No, we're Canadian. We always own gold stocks.
By the way, Ronnie's from Incrementum.
Incrementum, I got it. Sorry. Thanks for looking it up. Ronnie, I'm sorry. We love you, and we'll make sure we get your name right next time.
Maybe he should come back on.
We got his name right.
We should get him back.
Yeah.
Oh, yes, I got his name right, but we should get him back on.
Yeah.
For sure.
But until then, if you have any burning questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. We're there every day. Lena gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks. You guys know them. And please rate and review us on iTunes. Patrick, where can they find you?
You can find me on Twitter at Patrick Serezna and follow me at bigpicturetrading.com. And Kev, where can they subscribe to that fantastic, amazing newsletter of yours?
God, the cheese is just so, you put it on too much. I'd hate to have your grilled cheese sandwiches because there's too much cheese on it. You can check it out at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
All right. That was a great show. Lots of fun.
Patrick, you had to go pee. I should have checked.
The beer.
Because I'm literally talking, and all of a sudden I hear clunk. Hopefully Lena leaves in all the sound effects because it was funny.
I'm leaving everything.
Oh, good. That's
my God.
Yeah.
That's what's going to happen.
I messaged you on WhatsApp.
I know. I didn't recognize it. I didn't see it. But the funny part about this is that Lena tells me that she does do a little editing to take out my heavy breathing. I didn't realize that.
Mute that.
The Darth Vader.
Patrick, you're laughing, but you do that too.
It's because, you know why? I learned how to do the mic work when I went into the radio, and the fellow literally told me, like, really weirdly, to make love to the mic.
Yeah, but they have, they have the, what is that called? They have the guard thing on their mic. They have all the other equipment to it so that even if you do that, it doesn't catch all your heavy breathing.
Oh, I see. So they're filtering it or whatever.
Do you have that like soft thing on top of your...
I do have the soft thing on top of it.
But you need another guard in front of it.
Oh, so to take out my Empire Strikes Back breathing.
All right.
Okay, what's the beer?
Let's rate the beer. So this beer, Blurry Eyes. I love the name.
It is a good name.
It's what you need to draw thick crayon lines on the charts.
Nice.
You need to be able to kind of squint your eyes and create a blur. This beer helps with this. But you know what? I honestly think you'd love this New England IPA.
Because I do not like IPAs usually. It's taken me It's taken me 2 years to figure out. But I do not like IPAs.
Well, you know what? I honestly...
You gonna bring some home for me?
I am going to weigh my luggage, and I'm going to pack whatever weight I can with these cans in my check bag for sure. This is it's a great beer. I'm giving it an 8.1.
Nice.
It's well above the average. I don't want to give it crazy, but I actually am going to bring some home. I like this beer.
So I can just picture you at the airport with your beers, and then you put it on the scale, and you're like, "Oh shit, there's too much." And
I'll just drink one,
and you just drink some. And I got to tell you a story. There's a mountain in New Hampshire called Tuckerman's Ravine. Tuckerman's Ravine is this. I think it's a national park or it's a state park, and people go there and they hike up and they ski it, and it's the highest elevation in the east. It's not a real mountain when you compare it to the western stuff, but it's the next best thing on the east. So we went there one time when I was young, and I used to deliver bonds, like I was a messenger delivering bonds, and I went with this fellow that was a professional bond messenger, so that tells you like what kind of guy I'm going with. And we decided to bring a lot of beers, and we didn't realize how long the trip up there was and how long it was going to take us. So we literally, I think we brought a case of beer, and we might have brought a case of beer each. And it very quickly got tired, and people were passing us. And so what we decided, the only thing to do is drink them.
Oh, no.
So we drank literally 8 or 9 beers on the way up. So we couldn't ski that day.
Oh my god.
Yeah, that's how
That's
Canadians.
awesome.
That's how we do
you
it.
roll
That's how
down?
you roll.
We didn't roll down, but I remember thinking, well, we can't just pour them out.
Yeah, don't waste
And
it.
yeah, so we had to drink them.
That's
And the funny thing is, we tried to give them to other people climbing the mountain as they passed us. Nobody took us up on
They
it.
were probably like, "Are you crazy? I'm not drinking beers right now."
The fact that it was 8:30 in the morning
my
was probably had something to do with it.
that I am sure had something to do with it. That's hilarious.
All right, we've heard about your escapades in Houston. What about you, Lena? What are you up to these days? You got any good new shows to tell us about?
You know what? I'm on a television detox.
Really?
Yeah.
What?
I have not watched TV this week.
What?
It's been very
Really?
difficult.
Why is that?
Welcome to my world.
Yeah.
That's
I
It's rare.
just decided, you know what? I gotta take a break because then I'm giving Netflix and other platforms to, accumulate more shows, and then I can kind of binge watch instead of binge watching every day. So
right.
I'm giving them a break.
Nice.
I have been forced to watch Sex in the City.
Oh no!
Oh no.
The new movie or whatever.
The
Yeah,
new,
and
Oh,
new
no.
series, right?
So bad.
Oh,
And
no.
I commented.
I,
I commented in one of my letters at the bottom with someone was talking about it, and I said, I kind of I saw that at one point Big dies, and I felt
Spoiler
I-
alert!
well, listen, most people that are going to watch it have already watched it. He dies on the Peloton. Most people
He
know
dies on the
because they call-
Peloton. Oh,
Yeah, he
that's
dies
why
on the
there was the whole
Peloton.
Peloton.
But I've never been more jealous of anyone because at
Dying?
least it was fucking over for him.
Oh my god!
oh.
It is so bad. It is like literally the worst show I have ever seen. Like,
Well,
even my
no, I
wife,
wouldn't
we-
call it the worst show.
Oh, it was no. This is bad.
You were just not the right
There's a-
audience for it.
No, because you and my
No.
wife was like,
I-
we couldn't,
yeah,
we couldn't
I've-
finish. We couldn't finish one. We were just. It was so much cringe. We had to.
But wait, is this a show? Isn't it not a movie? Is it a? Is it,
No,
oh, it's a
no,
show.
it's like-
It's episodic.
They've come back as
oh
50-year-olds
no, yeah, that's
or whatever.
not good.
It's bad.
Any
And then Big
reunion
dies.
like 20 years later, I'm not for it. Like
And the Canadian actor, what's her name? Katrina Cottrell?
yeah, Kim Cattrall.
She was smart enough. Kim Cattrall, that's it. She was smart enough to tap out and say, I'm not coming. So they had to write her out.
She was my favorite when they were
Yeah,
running.
she just tapped out. She's like, I'm not doing this. She was smart. Or maybe they didn't ask
I
her.
don't know,
Yeah,
maybe-
she probably read the script
No, I'm
and
pretty
realized.
sure they were falling out a long time ago with like.
Oh, they don't get along.
I don't know the details. I just know that she just kind of had a fallout or whatever. But,
Oh.
And also that Mr. Big or whatever, I think he's being.
Oh, he's in trouble.
He's in big trouble right now. So
Yeah, he's
allegedly,
like they keep-
I don't know.
Yeah, well, yeah. I don't think that he's going to come after us. If we
I
say
actually,
anything.
he actually is married to a Canadian woman, or he was anyways.
Really?
He had a baby with a Canadian woman years ago, because I used to work with her cousin. Because she was like,
Oh,
oh, my
okay.
cousin is actually with Mr. Big. I'm like, okay, like relax, like don't make up lies to be cool or whatever. And she showed me a picture. She's like, yeah, like that's basically my cousin's husband. I was like, oh, okay, cool.
Well, there you go.
But
Your brush with stardom.
yeah, basically. But no, Sex and the City is. We should just leave
It's
it.
bad.
We should
So
just
anyway,
leave it
so
as
yeah.
is. It's like
Yeah.
Yeah.
And,
just
and then
doesn't
I have our kids are back, and so I have more young ladies in our house. So we I am now watching Emily in Paris.
Oh, I tried watching that because everybody was talking about it. I watched the first episode like 15 minutes and I'm like, nope, can't watch it.
well,
can't do it.
All I can say, I would take Emily in Paris any day over the Sex and the
Oh
City.
no, that's even worse.
Oh yeah, that's how bad Sex and the City is.
Emily in Paris, I think, is like I was cringing the whole time. The first 15 minutes, I was like, oh, this is terrible.
Yeah. You're just gonna want to shoot yourself on Sex and the City.
That's funny.
Oh well. Anyways, Patrick, when you home?
This Sunday. I just finished up the week-long trading, so tomorrow I'm just gonna go for a tour around. I'm gonna go probably check out the NASA Space Center here in Houston and go do one of the boardwalk kind of walks over there, and then I'm gonna get on a plane on Sunday.
Well,
Nice.
If you live in the Houston area, you can go to the NASA Space Center tomorrow, and maybe you'll bump into Patrick.
Ooh,
Well,
maybe.
so what happens if you don't test positive? I mean, negative. Are you stuck in Houston? What's the rules now?
yeah.
Do you have to test before you get on the plane?
Yeah, you have to have a negative test to get on a plane. I already did. I'm good. I'm good.
Oh God, you could have taken money off me. I was going to give 50-50.
No,
you're not gonna make it.
I'm coming home.
You're coming home.
I'm coming home
Great.
COVID free.
You can come
I'll
to the
bet
minus
you-
20-degree weather.
I'll bet you that you're not all your entourage makes it. Somebody will be stuck in somewhere.
Well,
I'm hearing all
probably.
sorts of stories of people stuck in places and
So
they can't get out.
how long does it take for you to test negative, or is that different for different people?
Well, this is weird because like antigen tests, like literally are like in many cases just contagious for like 5 days, but those PCR tests are uber sensitive, right? Like they pick that stuff off after you are no longer contagious because you just have it in your system. I don't know. Listen, I don't want to pretend like I'm a COVID expert. I'm just making shit up here. But we'll.
But did you see the people on the boats, on the cruise boats? They get a test, and then next thing they know, they're locked in the cabin for a week.
the whole trip.
Can you imagine that?
I'm sorry. Are the cruises back up and running?
Yeah.
And people are going on it even though...
Yeah, but then you can't get off at some places, and then it just spreads like
What's the point if you're going to get
wildfire.
stuck on the boat or on the ship?
Yeah,
or
and then
whatever?
you get confined to your cabin. It's got to be just a shit
That's
show.
terrible.
Yeah, can you imagine spending
No,
a week,
I can't
spending all
imagine.
this money, and then spending a week in your cabin?
Yeah, and I've never been on a cruise, and I have no desire to go on it, but I'm assuming the cabins are really small.
Yeah, if you have a balcony or something, that'd be all right to get some fresh air. But if you're on one of the inner cabins, Jesus, you're like in a closet.
But even then...
Have you ever gone on one, Patrick?
Yeah, I've done like a Bahamas one and stuff like that. But they're like little closets. Like look, you can go and take the luxury one where you get a nice balcony and everything like that, and then that's awesome. But you take one of the inner rooms and you get COVID, you're literally locked in a closet.
Oh my God.
Like you're it's the size of an office. Like it's like 100 square feet. Just
And then the boat's swaying. You can't get outside. Although I guess the big ones don't sway then, right?
yeah. You just wait when the boat is sinking. Once you see the water coming in, then you know you're allowed to go out.
You can do the Jack and what's her name?
Rose,
What-
I
from
think.
Titanic.
Rose?
Jack and Rose.
I think it's
yeah.
Rose, right? I don't know. I haven't seen Titanic in forever.
What a classic!
There's theories about, people say, oh, she was stuck on the door when the ship sank. And,
Oh yeah, and she could have fit him.
she could have fit
She
him on
could
the
have fit
door.
him. I mean, yeah. She just doesn't like Leo. She's like, the world's a better place without you, Leo.
Goodbye.
I think the greatest. I'll just leave you with this one thing. I thought the greatest line, and I think it was the best tweet of 2021, was remember when Jeff Bezos' new partner was looking at Leo?
Oh, yeah.
Yeah, you remember that picture, and everyone's like, "Oh, it doesn't matter if you're, the richest person in the world. When Leo comes, your lady friend is going to look at Leo."
It's Leo.
And then, yeah, but the funniest part is that this quant guy made a tweet, and he took all of Leo's girlfriends and put their ages, and then he figured out the standard deviation of their ages, and said, Don't worry. I don't think Jeff has got anything to worry about. That'd be like a 42 Sigma move.
Oh my God.
It was the funniest tweet of the
As he gets older, they get younger. It's
No, they don't
you
get
just
younger.
see-
They
I-
just stay the same.
They just stay the same. I think that the majority, like it's 22 to 27. I think the oldest one was 27.
I mean, it's Leo.
And there's a slew of
But
them.
it is
It's-
Leo.
It's not like it's 4. There's like 8, and they're all the same age. He just trades it like it's like leasing a car for him. He just trades it in for a new one.
Whoa.
Well, no, I'm just
Well,
telling you
let's
that's
say-
what he does. I don't think that's
I mean,
Whether
if
you
you,
agree-
if you were going
whether
to
you
trade in
agree
a car,
with it.
wouldn't you want to get a new one?
No, I would fall in love with a single car and drive that car.
and I
for the
would
rest of my
just
life.
drive it till it falls apart.
On that note, everyone, have a great week. We'll see you next week. Bye-bye.
All right, take care, everyone.